Global energy markets are reacting sharply to the escalating conflict involving Iran, with gasoline prices already rising and analysts warning of further increases in the days ahead. The cost of fuel affects households, transport networks, and the wider global economy. Now, fresh disruptions to oil flows, shipping routes, and energy infrastructure are raising concerns about how much drivers may soon pay at the pump. Tonight, we examine what consumers should expect to pay for gasoline as the war with Iran continues, and why the consequences are being felt far beyond the region. What you should expect to pay for gas as the war with Iran continues. Fuel prices are rising as global oil markets respond to ongoing attacks involving Iran. Analysts say the increases already seen at petrol stations may only be the beginning. In the United States, the average price for a gallon of regular gasoline stands at just under $3, according to the latest nationwide survey by American Automobile Association. The data, collected on Sunday, shows prices up by roughly 2 cents compared with the previous day and 6 cents. Higher than a week earlier, it marks the first time average prices have crossed the $3 threshold since early December. Market observers say the pace of change reflects rapid shifts in global oil trading. Wholesale gasoline prices in international markets are rising sharply, and industry specialists warn the impact will soon be visible at retail fuel pumps. Independent oil analyst Tom Closa, who advises Gulf Oil, says retail prices could increase by between 5 and 10 cents a day in the short term. He points to rising wholesale costs and strong reactions among suppliers. In comments to CNN, Closa describes what he calls a sense of urgency among fuel wholesalers, many of whom have raised their prices significantly amid fears of further supply disruptions. Global energy benchmarks are also moving sharply higher. The U.S. oil benchmark, West Texas Intermediate, rises around 8% in early trading, placing it on track for its largest single-day gain in years. Diesel futures have surged even more dramatically, climbing roughly 12%. Such increases in wholesale and futures markets typically take only days to filter through to consumers. Petrol stations often adjust prices quickly when underlying costs change, particularly during periods of heightened volatility. Rising fuel costs also coincide with the annual seasonal increase in demand. Consumption typically climbs in the spring months, as travel increases and refineries shift production to summer fuel blends. Historically, prices often reach their highest levels in mid-April. However, analysts say the conflict involving Iran has accelerated this seasonal trend. The combination of geopolitical uncertainty and supply concerns is pushing prices upward more rapidly than usual. Despite the current trajectory, experts say it remains unclear how high prices may ultimately rise. Before the latest escalation, some analysts predicted that average U.S. gasoline prices would peak near $3.25 per gallon. Now, forecasts remain uncertain, reflecting rapidly changing market conditions. While the situation is fluid, many analysts do not expect prices to approach the record levels seen in 2022. That year, global markets were disrupted by Russia's invasion of Ukraine, which drove average U.S. gasoline prices to a historic peak of $5.02 per gallon in June. According to Closa, global crude supply remains relatively strong, which may help prevent extreme price spikes, even if tensions continue. To understand the current surge in fuel prices, analysts point to developments in a critical maritime route, the Strait of Hormuz. This narrow waterway lies off Iran's southern coast and serves as one of the world's most important energy corridors. Approximately 20% of global oil supplies pass through the strait each day, making it a vital artery for international energy markets. Recent hostilities have brought shipping traffic in the area to a near standstill. Reports indicate that Iran has fired on several vessels, raising concerns among ship operators and insurers. Even limited disruptions in such a crucial channel can have far-reaching consequences. Oil prices are highly sensitive to supply risks, and any threat to a major shipping route can trigger rapid increases in global energy costs. Industry analysts say Iran would not necessarily need to block the strait entirely to drive prices higher. The perception of risk alone may deter shipping companies from operating in the area. Several major operators have already responded. The Danish shipping giant Maersk announces it is suspending vessel crossings through the strait. Meanwhile, Maritime Insurance School informs clients it is withdrawing coverage for war-related risks in the region. Without insurance protection, many commercial vessels cannot legally operate. Analysts say this could effectively restrict oil flows, even without a physical blockade, and could drive shipping costs significantly higher. Closa suggests that while Iran may not be able to shut down the strait directly, decisions by insurers and shipping firms could have a similar effect on global supply. Beyond shipping concerns, energy infrastructure across the Persian Gulf region has also come under pressure. A fire breaks out at the Ras Tanura oil refinery in Saudi Arabia after shrapnel from intercepted Iranian drones falls on the facility. The Saudi Energy Ministry reports that the fire is limited and quickly brought under control. However, Reuters reports that production at the refinery is temporarily suspended as a precaution. Analysts say modern energy facilities are vulnerable to drone and missile attacks, which can disrupt operations even without causing extensive damage. Further incidents are reported elsewhere in the region. The state-run company Qatar Energy halts production of liquefied natural gas, following an Iranian strike on its facility in Ras Laffan. Meanwhile, according to the Kuwait news agency, falling shrapnel strikes a major oil refinery in Kuwait. These developments add to market uncertainty, affecting not only oil but also natural gas prices. The European benchmark for natural gas rises sharply in response, reflecting concerns over supply disruptions. Energy analysts note that Europe and Asia rely heavily on liquefied natural gas exports from Qatar, one of the world's largest suppliers. Yet some experts, including analysts at Rystad Energy, say current global supply levels may prevent a repeat of the severe energy crisis experienced in 2022. Sanctions and global trade patterns also play a role in the current situation. The United States and many European nations have imposed restrictions on Iranian crude exports for years. However, China has emerged as Iran's largest oil customer. Analysts say that if China is forced to seek supplies elsewhere, competition for oil in global markets could increase, raising prices worldwide. Because oil is traded internationally, shifts in demand or supply in one region often affect prices everywhere, including at petrol stations far from the conflict. Energy experts and industry observers continue to monitor developments closely. Tom Closa says the market response reflects a combination of real supply risks and heightened anxiety among traders. He notes that wholesalers have raised prices sharply amid concerns about potential future shortages. Closa also emphasizes that global crude supply remains relatively abundant, suggesting that while prices may rise, extreme shortages are not inevitable. Other analysts highlight the broader economic effects of rising fuel costs. Oil analyst Andrew Lipow says higher diesel prices could affect transport and logistics industries, particularly trucking and rail networks. He warns that rising fuel costs may lead companies to introduce surcharges, increasing the price of consumer goods and placing additional pressure on households and businesses. Officials in affected countries have issued statements seeking to reassure markets. Saudi authorities say the fire at the Ras Tanura facility is contained. Energy companies across the region say they are assessing damage and working to maintain supply. Meanwhile, political leaders are closely watching the economic consequences. Rising energy prices have historically influenced public opinion and economic policy decisions. In the United States, higher fuel costs could affect the political landscape ahead of upcoming elections. President Donald Trump recently highlighted low fuel prices in a national address, underscoring the political significance of energy affordability. The consequences of rising fuel prices extend far beyond the cost of filling a car. For consumers, higher gasoline prices increase everyday expenses, affecting household budgets and spending patterns. For businesses, especially those dependent on transport, fuel costs represent a major operational expense. The sharp rise in diesel prices is particularly significant. Although relatively few private vehicles run on diesel in the United States, the fuel powers much of the country's freight transport system. If trucking companies face higher fuel costs, they may pass these expenses on to customers through increased shipping rates. This can raise the cost of food, manufactured goods, and essential supplies. Agricultural sectors may also be affected. Rising fuel costs increase expenses for machinery, transport, and fertilizer production, particularly during the spring planting season. In colder regions, households that rely on heating oil, a product closely related to diesel, may face higher energy bills. Globally, the effects are even broader. Higher oil prices can contribute to inflation, influence currency values, and shape economic growth. They also affect developing economies that depend heavily on energy imports. The future direction of prices will largely depend on whether shipping routes reopen, whether infrastructure damage remains limited, and whether global supply continues to meet demand. Market stability could return if tensions ease or if alternative supply routes are secured. However, prolonged disruption may lead to sustained price increases across global energy markets. Closing. For now, energy markets remain volatile as the conflict involving Iran continues to reshape global supply and demand. Drivers are likely to see higher prices at the pump in the coming days, though analysts say the scale of future increases will depend on developments in the region and the resilience of global oil supplies. As governments, companies, and consumers watch closely, the cost of energy once again highlights how geopolitical tensions can have immediate and far-reaching economic consequences. That is the latest on global fuel prices and the ongoing impact of the conflict. We will continue to monitor developments.